Welcome back to another stock analysis, where I'll look at some key metrics to calculate the fair value and my buy price for the stock. Today I'm going to analyze Intel, which is one of the biggest companies in the semiconductor sector. Last, they generated a revenue of $75 billion and they have a market capitalization of $155 billion. The income of Intel comes to 51% from the client computing group, 33% from the data center group, 7% from Internet of Things, 5% from non-volatile memory solutions group, 2% from the broker mold solutions group, and the last 1% from other. Regarding the geographically diversification of the company, it is informed that 27% of the revenue is made in China, 18% is made in Singapore, 18% as well in the US, 17% is made in Taiwan, and 20% in other regions. Intel seems to be good diversified in different countries. Especially interesting is the Asian contribution of the revenue. Now let's find out if Intel is a good stock to buy at its current value. The key matrix I use to calculate the fair value and buy price for Intel is the dividend yield. I'll start with plotting the dividend yield for the last few years in a historical chart. I choose the dividend yield because a consistent dividend policy for me is the best indicator for a stable company. Additionally, a steady dividend payout helps to stabilize my portfolio and it makes it easier to rebalance my positions. To create some sort of signal line, I take the 5 years moving average of the dividend yield and plot it in the chart. The simple approach is now that the stock seems overvalued when it's under the moving average and undervalued when it's over it. The average of the last 5 years is 2.56%, and I would like to define this as the historical dividend yield. Since the historical yield is the fundament for my fair value and buy price calculation, this value shouldn't be too volatile. In an ideal case, the curve would give a straight line. I can measure how much the curve deviates from this ideal straight line by calculating the relative standard deviation, which for Intel is 10.3%. To the historical yield, add a personal defined margin of safety of 25%. This margin of safety will be adjusted upwards or downwards depending on the matrix of the company. My first criteria is the stability of the dividend measured with the relative standard deviation. With this value I can measure how volatile the dividend yield is. A high relative standard deviation would higher my risk to invest at a bad timing. As said earlier, the relative standard deviation for Intel is 10.3%. This value is in the yellow section of a rating scale. Therefore, the margin of safety doesn't change. As a dividend investor, the dividend growth of course is a very important matrix for me. In 2007, 45 cents were paid, and in 2022, $1.55 is expected. Intel have not decreased the dividend for 29 years, but they've only consecutively increased the dividend for 7 years. As seen in the years 2013 and 14, the dividend rate was the same. In the last 5 years, the average dividend growth was 6.1%. A dividend growth of 6.1% is in the yellow section of a rating scale. Therefore, the margin of safety once again doesn't change. By looking at the payout ratio, I'll find out if this dividend growth is sustainable for the company. I always look at the payout ratio in respect to the free cash flow, which is the cash flow the company has available after they've paid all necessary expenses. The free cash flow from Intel has decreased from $14.3 billion in 2018 to $11.3 billion in 2021. The cash dividend were respectively $5.6 billion and $5.7 billion. The average payout ratio thereby becomes 39%. This value is in the yellow section of a rating scale, and therefore the margin of safety doesn't change. Next, I'll take a look at the debt situation. The company has a debt of $9.7 billion and have $28 billion in cash. When the cash gets subtracted from the debt, and this value then gets divided by the EBITDA, the debt to equity ratio is found. And the EBITDA is currently at $32 billion. Since the company has more available cash than debt, the debt to equity ratio becomes zero automatically. The debt can't be negative, therefore the numerator becomes zero, and the fraction becomes zero if the numerator is zero. Enough about mathematics. The debt to equity ratio tells us that the company could pay off the whole debt at any time if they wanted to. This is of course a very good value, and for this matrix I subtract 5% from the margin of safety. For the business to be sustainable, growth is a very important factor. The revenue has increased from $63 billion in 2017 to $75 billion in 2021. This gives an average growth of 4.5%. In the same period of time, the EBIT increased from $20 billion to $22 billion, which gives an average growth of 3.2%. The margin is found by dividing the EBIT with the revenue, which in 2017 gives 31.2% and in 2021 decreased to 29.7%. Since the revenue increases at a higher rate than the EBIT, it only makes sense that the profitability of the company decreases. In this case, it decreases with 1.2% in average. An EBIT growth of 3.2% is in the yellow section of a rating scale, which gives no further adjustment. An average margin decreasement of 1.2% gives plus 10%. The last thing I'm looking at is the potential yield on cost. This matrix tells how great a potential investment in Intel would be and what annual income I could expect in a few years. Intel have a dividend yield of 3.83% and a dividend growth rate of 6.1%. I assume that the dividend gets fully reinvested at the same conditions, but I subtract 15% from every dividend payment because there are 15% withholding taxes for stocks coming from the US. After 5 years, the potential yield on cost is 6.4%, after 10 years it is 11.2%, and after 15 years it is 21.5%. I only calculate the potential yield on cost for the coming 15 years because of the natural uncertainty of this matrix. A yield on cost of 21.5% after 15 years is in the yellow section of a rating scale. Therefore, the margin of safety doesn't change. Since every matrix for my analysis has now been collected, it is time to adjust the margin of safety. Minus 5% for the debt and plus 10% for the margin growth. Especially for Intel, I would like to add an extra 5% to the margin of safety for the relatively short history of consecutive dividend increasement. The new margin of safety is therefore 35%. This leads to a desired dividend yield of 3.46%. By a current dividend of $1.45, I should therefore don't pay more than $42 for the stock. By ignoring the margin of safety, the fair price of the stock is determined, which for Intel is $57. These values can also be shown graphically in the chart for the historical dividend yield. This is done by adding the margin of safety to the historical yield curve. This then gives a new curve which always lies 35% over the historical yield. As seen in the graph, the historical yield and the margin of safety are under the yield curve. Therefore, I consider the stock as undervalued. Finally, I consider the stock at its fair value. When the price is $57, I will buy the stock at $42, and the stock price is currently at $38. If you did like the stock analysis, please consider to give the video a like. Let me know in the comments which stock you would like to see next, and subscribe to my channel for more content.